Hello and welcome to another episode of Darwin Investors. Well, it looks like old Boris Johnson had to resign last week as the UK Prime Minister. Apparently, he's a bit of a party animal. But I really wish that somebody would have asked this of me years ago. I could have told you that he was. I mean, he had all the telltale signs. He looked straight out of the Alpha Tau Omega fraternity. Maybe a little bit unkempt, maybe a little bit uncomfortable looking in a tie. Perhaps sometimes he has a little bit of trouble with stairs. This is to be expected. But I think the biggest sign that the man was a party animal was that he dates way out of his league. That is the biggest sign of them all. And, I'm not mad at him for that. Actually, I really like him. If he's ever, hey, Boris, if you're ever out there in South Jersey, go ahead and leave a comment and we'll get out there and we'll party together. And I got lots of rooms in this house. You can go ahead and crash at my place. All right, let's go ahead and transition over to the markets. So we're doing it, folks. We're building our street cred. I think that things are going to turn around at some point. I think that we are nearing a bottom. At least we're going to know for sure whether we are by the end of July. And I'm going to show you all the reasons why I believe that. We'll have a look at my options portfolio, how it did last week, and how I'm positioned next week. So let's have a look at the S&P index over a 90-year history to see where we rank right now relative to other bear markets in history. And if the year were to end right now in 2022, we would be down 18.19%. Now, where does that rank historically? Well, we haven't been this bad since 2008 during the great financial crisis. Now, remember, during that time, Freddie Mac went under, Fannie Mae went under, AIG, Lehman Brothers, Bear Stearns, car companies were being bailed out. Banks were being bailed out. I mean, this was a true financial crisis right here in 2008. And this is the last time we were as bad as we were today. Prior to that, it would have been 2002 in the dot-com bubble. Prior to that would have been back here in 1974 during the big oil crisis of the 70s. Prior to that would have been, looks like, 1937, we had Adolf Hitler running around. That was going to be a problem. And prior to that, we had the Great Depression. So really, outside of about 4 or 5 times in our history, this year has been worse. And so let's have a look at what would have happened if 2008 were today. So in 2008, March 16th, Bear Stearns collapsed and it sold out to JP Morgan. So on March 16th, 2008, Bear Stearns, the 85-year-old investment bank, narrowly avoids bankruptcy by its sale to JP Morgan Chase. That would be like Goldman Sachs going out of business right now and having to sell out to, say, Bank of America. And let's see how the market reacted to this in March 16th of 2008. So in July 2007, the S&P was at 1552. After the Bear Stearns collapse in March of 2018, we're about 17% down. Not quite as far as we are now, but still down about 17% on March 14th. However, that quickly rebounded, and then by May, we were only down about 8.9%. Okay, so if the same thing had happened today that happened back in 2008, we would be down like 70%. I mean, right now, all we have is the thought that there could be a recession, even though we only have 3% unemployment. And look at that drop right there. Here was our drop after banks were collapsing right here in 2008. Nothing. It wasn't until reality really set in that it really went down. But look at how quickly we're going right now. So what drove the markets up this week? Well, the biggest thing was that Samsung released their earnings and they were better than feared. And that spurred all of the semiconductor chips to rally. Actually, and then that made the whole entire NASDAQ rally and even the whole S&P 500, considering the fact that all of the biggest weighted stocks are part of the NASDAQ in the S&P 500. And what they reported was They had a second quarter revenue rise to 22% year on year. Now they're trading in Korean won. So this thing that where, say, when Apple reports, they're going to say, hey, the foreign exchange is hurting us. In Korea, the foreign exchange helps them. So it would be interesting to see after Apple reports what the difference is when we're talking about foreign sales. Now, Samsung, they had their operating profit, it was expected to grow around 12% to 14 trillion, but they said that was the slowest rise in more than 2 years, and they missed expectations. However, the results were better than feared, and because the results were better than feared, the entire stock market went up. In particular, the semiconductor stocks went up. And also reporting on Thursday after the close was Levi's, and this was a really interesting report, and they hiked their dividends. The second quarter earnings exceeded expectations. And so Levi's reported revenue that was 1.47 billion versus 1.43 billion expected. Their earnings were more than expected, and their international sales grew more than expected by 17% in the Americas, 3% in Europe, and 16% in Asia compared to 2021. It looked like it was driven also by sales of their other brands like Dockers and Beyond Yoga, increase of 56% compared to last. Don't worry, guys. We'll figure out what Beyond Yoga is, and I'll get a whole side video about that coming up later. It seems like that people have jobs. We're buying jeans. We need not be necessarily buying Apple phones, but we are buying clothing. This was a nice surprise. I wasn't really that surprised myself, but a lot of analysts were surprised. If you look at my last video, I kind of expected Levi's was going to go up. Another company that reported last week is WD-40. And you remember last week, I wasn't that high on this company, and I had my reasons. The reasons is they're a very one-dimensional company. Their management blamed the translation of the company's foreign subsidiary results to US dollars, as well as other global disruptions for sales decline. An explanation that doesn't really mix well with water. And so I have an explanation for why WD-40 maybe didn't do well this past quarter, and hear me out on this one. So like most people, I have a can of WD-40 in my garage. It's about 10 years old and it's about half full. So if I were WD-40, I'd sell smaller cans. That would be my suggestion to WD-40 to make sure that they don't have any more bad quarters. So let's go ahead and have a look at my options from last week. Last week from July 1st until July 9th. And if we really want to get technical, we go to July 5th. So last week from July 5th until July 9th, made about $335 in options. I sold 2 puts, I sold 2 calls. The 2 calls I sold were on stocks that were up last week. You want to sell calls when your stocks are up. You want to sell puts when your stocks are down and you believe they're fairly valued and they can't go down anymore. And you wouldn't mind owning more of these stocks. That's really key. But I thought that the risk to NVIDIA and AMD was to the upside, so I sold puts. And I also sold the calls because I thought the risk to Amazon and UPS was to the downside. You can see that my total gain and loss in these, 54%, 62%, 33%, and 74%. I don't have to go to the maximum to 100%. The whole point of options is you want to get in, get out. When you see that you're ahead, buy them back. And then once you buy them back, wait for another opportunity to get in there and sell it again. But let's talk about what happened last week. So yeah, I did sell out of all of my positions, and you may say to yourself, why would you not just hold these positions? I felt like I could sell out of them and buy back into them later. And the reason why I felt that way, after Samsung reported, you can see that NVIDIA went up about 11.5%. So if a lot of big banks had short positions on NVIDIA, they were losing their shirt right then. And so I was kind of waiting for that to come back down so that I get out of it. And the opportunity came when they gave out that jobs report, and the jobs came out better than expected. And so they tried to spin it in such a bad way and say, oh, that's terrible. Let's crash NVIDIA, right? Well, all this wasn't necessarily like saying it was bad news, but it's saying that we need any excuse to bring this down so we can get out of our short positions And what that did was with everybody unwinding their short positions, and this is when I unwound all of my short positions, all of my covered calls, not just NVIDIA, but everything, it was right here. But what that did is it sent the whole market straight up, and this would be NVIDIA going straight up. Now, at this point, I could have sold a covered call on NVIDIA thinking it was going to keep, that I could sell one way out of the money up here. But what I thought was going to happen because of the way that we had this unexpected rise for the last 3 days, what I thought was going to happen was I could wait here to 10 minutes to the end and sell more covered calls as this thing just spiked even higher. But what happened was it didn't happen. And I ended up selling all of my covered calls at about 3:45. And while NVIDIA might be one small case study, and certainly the semiconductors bounce more on the Samsung news than everything than other equities might have done. The S&P 500 in general would have done similar things, and in fact it did. It came way down on Tuesday. We're saying, oh, the bottom's falling out. We're going to recession. Michael Burry's right. And then on Wednesday they reported, and everything went up about, not much. The S&P had a decent week, but it was up a couple percent. But in any case, people did have to get out, unwind some of their short positions that they might have been in. And so what else came out last week that might have impacted the markets? Well, we had the PMI data came out. It came out at 53. So what is the PMI? Well, the PMI is the Purchasing Managers Index. It's an index that summarizes economic activity in the manufacturing sector. The index is based on a survey of manufacturing supply executives conducted by the Institute of Supply Management. Participants are asked to gauge activity in a number of categories like new orders, inventories, and production. And these sub-indices are then combined to create the PMI. A PMA above 50 would be designated as overall expansion, and under 50 would be manufacturing contraction. And you can see right now that for this past month, we were sitting at 53. You can see 53 is not bad. It puts us pretty much in line where we've been since December 2021. 53, of course, had been higher than any of the numbers we had between, say, April 2019 and June of 2020. So that's actually not bad. So what's the significance of the PMI data? So when you look at this chart here, this is a very interesting chart that kind of illustrates the connection between PMI data and the S&P 500. And so when the PMI data is in blue, the S&P 500 is in red. We can see that they follow each other very freaking closely. Isn't that eerie how close that is? When the PMI comes down, the S&P 500 goes down. When the S&P 500 goes up, when the PMI goes up, the S&P 500 goes up. Right now, the PMI data is coming down, but not that far. But look at this exaggeration of the S&P 500 right now relative to our PMI data. So what this would indicate to me is that either one of two things has to happen. Either the PMI data has to come down and meet this line, or this line has to go up to meet that line. But what doesn't generally happen is this huge divergence that we're seeing right now. I suspect, based on the Levi's earnings and the Samsung earnings and the fact that we have very low unemployment rate, that this red line is going to have to come up and meet this blue line. That's kind of my feeling right now in the market. Now let's go ahead and see how this market can be manipulated. So we got Jefferies here. It sees an attractive entry point for Snowflake and upgrades the shares, predicts 35% upside. And then when you look at Snowflake, it's not that great of a company. Why would Jefferies just suddenly just reach out and just say, let's go ahead and upgrade these shares? I mean, we're talking about a cloud computing company who has a very small market share. And when you're looking at the worldwide top 10 leading cloud vendors, Microsoft is by far number one, and then Amazon is number two. And then where is... Oh, there's Snowflake right there. And this one's going to be the one that's just, go and buy Snowflake. And then when you look at Snowflake's numbers, it's not the sort of thing that's kind of in vogue right now. There are times when you really want a high growth company, and there are times when you want a value company, but right now is not the time for these high growth companies. But that's in fact what Snowflake is. But it's graded F by Charles Schwab. have a net profit margin of negative 45%. They're a huge money loser. When you look at their income statement, you can see that, yeah, they grow like crazy. And in a lot of markets, this is a great stock. And believe me, in another time, I would be all over Snowflake. This would be exactly what I would be going for in another market. But right now, this is not what I'm going for. Right now, it's like UPS, Lowe's, JP Morgan. These are the things I want. And the reason for that is because, yeah, it's growing like crazy. But look at this, year after year, they just lose more and more and more money. It's not like they're growing and making and losing less money. No, they're growing, but at a cost. And it just isn't the sort of thing that's in favor right now. So when I look at a headline like this one that says that Jeffrey sees an attractive entry point for Snowflake, what I see is this. I'm not reading these words. What I want to say is Jeffrey owns a lot of Snowflake, needs you to buy it now, and they're hoping some computer algorithm will pick up on this. And then we see stocks making the biggest moves in the pre-market. You got Nike, Spirit Airlines. And so then when you go on down here, you see that Jeffrey slid 4.4% in the pre-market after quarterly profit fell short of analyst forecasts, although the investment firm's revenue did exceed estimates. Revenue was down 30% from a year ago amid what Jefferies calls a challenging capital market environment. And then just a few little bits later here, you got Snowflake gained 3.4% in pre-market action after Jefferies upgraded the cloud company computing stock to buy from hold. So this is how Jefferies is trying to manipulate and cook their own books. But they're not the only ones that are in neck deep on Snowflake. It looks like that JP Morgan also needs you to go out and buy some Snowflake right now. So Snowflake is upgraded as a favorite among CIOs. Shares of Snowflake were spiking Thursday after the stock received an upgrade to overweight at JP Morgan. And so that's how these companies get you to buy this stuff. And a lot of it has to do with options. And so that's why I sometimes look at these headlines a little bit differently than other people look at headlines. And these banks and Snowflake aren't the only ones doing this sort of thing. If you look at this right here, actually what I'm trying to show you is how to read these headlines a little bit differently. And so this one here, Piper Sandler lowers Microsoft estimates due to foreign exchange headwinds from persistently strong dollar. Okay, so now we just saw that Levi's earlier in the day released earnings and wasn't showing that they were having any problems with a strong dollar around the world. And now I would say upwards of half of the S&P 500 companies do business around the world, and they're not having problems. However, Piper Sandler decides they're going to single out Microsoft and say that they're having the problems. Now, Microsoft did single themselves out, so they didn't do themselves any favor. But what I read when I see this headline is Piper Sandler either A, wants to buy more Microsoft and miss it when it was lower, or B, holds a lot of short positions on Microsoft and needs to exit this position by the end of business today. And so that's what I'm seeing. And I would say that given the fact that this was published on Friday morning at 9 o'clock before market opens, and they need to exit these positions by the time market closes on Friday, I read this as Piper Sandler holds a lot of short positions on Microsoft. They're very upset that Samsung reported good earnings on Wednesday, driving the price of Microsoft up and so that we might lose a lot of money. So would you please sell your Microsoft so that we don't lose a lot of money also? That's where I read this headline. And it did work because you can see that Microsoft on Friday, on a pretty good day for the market and the NASDAQ in particular, was down 74%, finishing at 267.66. So you can probably assume that Piper Sandler had their shorts set at about $270. So they were clear. They made their money. Microsoft can go back to going up next week. It's okay, Piper. We got your back, buddy. But you know what? I actually sold out of my Microsoft position on Friday as well. So it did benefit me as well. All right. So what else have we got going on this week? Well, here's a head scratcher. Analysts still see earnings rising this year, even as the U.S. teeters on a recession. Man, no, I tell you what, That is a thinker. What could possibly be causing that? Well, people have jobs, and if you have jobs, you spend money. That's just kind of the way it works. So payrolls increased 372,000 in June, more than expected, as jobs market defies recession fears. And so when you look at this here, the strong $372,000 gain in non-farm payrolls, if you included farm, I wonder how much big this number, if you include like this plus farmers, this might have been a lot bigger. But anyway, non-farm payrolls in June appears to make a mockery of claims the economy is headed into, let alone already in, a recession. But however, based on the fact that we gained all these jobs, stocks opened slightly weaker following the news, while government bonds were sharply higher. So stocks were down. So it reminds me of like when I tell my wife something, and I'm like, you can interpret this one of two ways, and one of the ways is going to piss you off, and the other way will not. Well, I meant the one that doesn't piss you off, right? And so that's what's kind of happened to me in this. That's one way to look at this. But the other way is that we needed the stocks to fall in order to close out of our short positions, because I am very much a cynic when it comes to options. When you deal with options the way I do week on week, you smell rats everywhere, and this was one of them. That we were just looking for any excuse to sell off, so we get out of our shorts, unwind, send the market up, and then we could continue on as normal. And I think that this week coming in is actually going to be a reset. Now, before we look at the week that we have going forward, let's have a look at this here headline. Wimbledon stars were forced to play braless as rules come under heightened scrutiny. Now, come on, people. We're trying to, you really want us to tune into Wimbledon? Like, it's like, do you really think just because some of these tennis players were forced to play with no bras on, that was actually going to get some of us to actually tune in to tennis? Well, you would be correct. Boris, come over to my house. We'll watch some tennis. We'll have a couple of pints. We'll have a good time. All right, so back to stocks. Making money's fun too. So here on July 13th, that would be next Wednesday, the CPI data is supposed to come out, and actually the data is actually not supposed to be very good. The expectation is we had 8.6% inflation in last month that was reported, and this month it's expected to be 8.8%. It's going to be very interesting to see how the market responds to this, because it's either going to be, wow, the sky is falling, or the market could actually bump and go in the other direction. And the reason why is because there's an expectation that in future months that inflation will drop because commodity prices are dropping. There's also an expectation that because commodity prices are dropping, we're expecting a recession. And if we're expecting a recession and commodity prices are dropping, we're expecting the Fed to actually lower interest rates in the future, not at this meeting on the 26th and 27th. However, in the future, we're expecting that they're not going to twist quite as tightly as they were otherwise. So let's go ahead and have a quick look at this video that Steve Liesman put out on CNBC explaining this little phenomenon.
That meeting may have contained a small bone for stock market bulls. Senior economics reporter Steve Liesman thinks he's found it. Steve.
Hey, Melissa, yeah, you got to squint to see it, but there's a line in the Fed minutes that suggests all is not doom and gloom when it comes to the outlook for Fed policy. But before I get to that, I want to show you the doom and gloom that's in there for stock investors near term. The inflation fight is job one. The Fed is willing to accept slower growth, and the policy will go restrictive, may need to go more restrictive if inflation remains out of control. The minutes suggest a hike of 50 or 75 basis points coming at the meeting later this month. Little of that bodes well for risk assets until you consider this statement from the minutes. Quote, after the Fed hits neutral or just a bit beyond, quote, the committee would then be well positioned to determine the appropriate pace of further policy firming and the extent to which economic developments warranted policy adjustments. In other words, there's no guarantee the Fed may have to raise rates to punishing levels, and some chance they may not. If you look at what Peter Williams from Evercore ISI wrote yesterday, quote, the silver lining for risk assets is that the committee underscored that as policy gets to the vicinity of neutral, it becomes more data dependent again. Now, if you think inflation is going to stay sky high, then all of this is just wishful thinking. If you think inflation could come down and the economy will cool quickly, maybe the Fed has less work to do. That's what the market looks to be pricing in. Take a look here. During the June meeting, the market saw the Fed going to 370 by year end. It's now priced at 336. The market was priced for a 410 funds rate in May 2023. But as Joe and you were talking about earlier, that's now priced at 340 because the world has changed. As priced now, the Fed would stop just a bit above neutral. The hope is that it stops there because inflation's under control amid a slowdown, not a recession. It's a positive outlook, but like I said, you got to squint to see it.
So it looks like the expectations of a recession could possibly lead to the Fed not hiking interest rates as high as what was previously expected. And that's actually a good thing for the markets. So what's on the agenda for this week? Well, we have earnings starting this week, so that's always an interesting week for the markets. On Tuesday, we have Pepsi that starts. We have Delta on Wednesday, Morgan Stanley and JP Morgan and Taiwan Semi Conagra report on Thursday. And on Friday, we have more banks. The earnings week always starts with banks. And on Friday, we have PNC, Wells Fargo, Citi, United Health, and US Bancorp. On Wednesday, we have the CPI data comes out on Wednesday. Now, like we said, we expect it to be high on that day. I think everybody does. However, I don't know if the market's going to look past it because of commodity prices that we're going to expect that the next inflation print might be lower. So we might be looking forward to next rather than reflecting upon the one we just had. And so when I look at my options positions that I have open for this week, you can see that I've sold options on all of them. All of them expire on the 15th of July, which is next Friday. I have options sold for every single equity that I own with the exception of JP Morgan. And what I'm expecting is one of two things. So I'm thinking that Tuesday could be a pretty bad day in the market. And what I'm thinking is that everything's going to go down on Tuesday in anticipation of the inflation release first thing on Wednesday morning. And so what I'm hoping to do is kind of sell out of all, or at least buy back all of my covered calls on Tuesday. And then I'm going to sell puts on Morgan Stanley and JP Morgan on Tuesday in anticipation of the market shaking off this inflation report and then the banks reporting good earnings. Now, the banks could run into a little bit of problems. The analysts could have a little bit of problems with either loan defaults. They could have problems with the fact that they're not the investment banking firms such as Morgan Stanley are not processing any IPOs and things of that nature. And trading, I believe, because of volatility, trading is still going to be okay. But and they're going to have plenty of money on their balance sheets because people are still taking out loans. But it just remains to be seen how people are going to interpret this data. How are they going to interpret the data from the banks? They did not take the stress test from the banks particularly well. Banks showed that they were in good health. However, the market just shook that off and said, no, banks must be bad because we have a recession coming. So we don't know how they're going to interpret this data, but in my opinion, because they've come so far down that they're actually going to bounce up. For that reason, I'm going to sell puts on Morgan Stanley, JP Morgan on Tuesday if the market crashes in anticipation of a worse than expected inflation print. And then because I own shares in JP Morgan and I haven't yet sold covered calls on them, after they report on Thursday, I'll be expecting their stock to bounce up because I think that stock is going to go up. And at that point, if it goes up like $5 or $6 a share, that's when I'm going to sell my covered calls on JP Morgan. And if the market doesn't crash after the bad CPI read and after the Fed hikes interest rates. That's going to happen on the 26th and 27th of July. And after Apple reports their earnings on the 28th of July. And if the market is not crashing on what we anticipate to be bad Apple numbers and poor guidance for the companies reporting between now and then, on top of the high inflation read and interest rate hikes, if the market doesn't crash on all that, our bottom is in. And I would say that at that point, we can really start pushing money in, because I think the bottom would be in, because that's an awful lot of bad news. All right, so if you got into this video, please like, subscribe, hit that little notification bell. And as a matter of fact, there's like a little contest going on amongst YouTube's finance people, and it's like who can pick the best stocks over the next few years. But it takes a minimum of 10,000 views in order to get into this contest. That's per video. And so all I need for my channel is to have another 10,000 views per video. So if you would do me a solid, just kind of share this with your friends so I can get in this contest. I can show that I can pick stocks worse than anyone else. I'm really not a stock picker. I'm more of a, just give me great stocks and I'll make the most of them. I can do it with pretty much any stock. That's kind of the way I see the market. I don't need the market to come to me. I go after the market. But anyway, if you do me a favor and just like us spread this so that I can get my 10,000 views so I can get in this contest, it would be much appreciated. Until then, have a great day. Bye.